Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here today. Hopefully you had a good weekend. We're back at it, and it is a busy earnings week. Because of that, since we have earnings, I want to talk about implied volatility today. And I'll kind of dive into why we're going to talk about that. But since there is so many earnings examples, I want to talk about implied volatility, and then we're going to wrap technicals into it. Now, just real quick as we're getting started, just a quick reminder, we have Brent Morris in the chat, fellow instructor. We welcome him. And we welcome Amun, Naresh, Robin, Don, Will, Ocean Life, JP, shout out to JP, and many others. Now, just real quick, remember the information here is provided for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Now, also remember when we talk about examples, we will be looking at those on the paper money software application for educational purposes only. Investing involves risk, including loss of principal. And today, what we're going to talk about first, let's take a quick look at where the market is. Okay. When I say market, we'll look at indexes and sectors. Okay. Second, with that, what we'll talk about is I want to talk about implied volatility. Okay. And want to kind of show in a little example about implied volatility, how it affects the prices, and also wrapping into that some of the technical analysis with it as well. And again, the reason why we're going to talk about that is we're going to pull up a number of stocks that have earnings this week, okay? And the reason why we want to bring this up is when you invest, some investors, they're trying to forecast a direction. Some maybe just want to maybe make money or try to make money from time or try to benefit. And the other one is maybe the investor is actually saying, look, James, I actually don't think, I think the direction could go down. And that's what we talked about last week. There are still a couple of examples that we could bring up about that here today, and we'll kind of try to see if we can't slip those in. So again, understand that not all investors are trying to forecast an upside direction. Some might think the stock is going to go down, and some might also think the stock is going to be neutral. At least three different types of trends here that we could focus on. Now, with that, let's go ahead here and just take a quick look at let's start with the SPX for just a moment, okay? So if we look at the SPX, okay, and this has been very interesting to watch, and if I pull up just real quick the SPX, here's that the white line represents kind of the level of horizontal resistance we drew from Friday. The 61% line, 54.18, that was the line we wanted to get above, and so far we have. And actually yesterday we closed above it. Today, bearish engulfing back down. However, price is still above both moving averages and still the green shading. Neither of the moving averages are red yet. And if we kind of put in context the down move, it's down 0.8%. So it looks like a big red candle, but really not that bad as far as percentage-wise here. Now, the NASDAQ itself, pull that back up. This one's kind of gotten to a major area here. This 19,263 is where we had a pretty good gap down. We fell down through the floor on 328, okay? And what we're seeing is we're getting back above so far. And remember, we kind of said if the market's going to go back up, usually you got to get leadership from the tech space, okay? And so far, the NASDAQ has done a pretty good job leading the market back higher. The VIX, pull this back up. It's not gone down. What? Friday we closed at where? 24.84. Okay. Today, a little hammer down near potential, maybe where it broke out from. Not a huge hammer, not changing the color of the moving averages at all, but trying to fight back a little bit. Now, some of this volatility might wane after we get through some of the earnings. Okay, so let me kind of show you what I mean by some of the earnings. Well, let's go to Schwab.com for just a moment, okay? Schwab.com. And what we're going to do is we're going to log in, go to research, and we're going to go to calendar, okay? Now, if I go to research and then calendar, you're going to see we got today's events. Maybe there's economic events like macro numbers on the economy and so on. Earnings, okay, is definitely what we're going to focus on, okay? Now, if I click on earnings and I click on that, what I want to do is I really want to focus down and just kind of look at some of the companies that have announced. So if you say, James, show me that again, go to research and then go to calendar. Okay, so not too bad. And then just click on earnings and then we'll get here. Now, what you're now going to see is we are highlighted on the week of April 28th. Okay, so Domino's Pizza, for example, if some of you followed that today, they actually got DPZ announced this morning before the open. Okay, that was 4:33. Now, think of this as some of the due diligence that you're trying to set up some trades for this week potentially. But you could also say, look, I want to go look in the next week and so on, and we just have to click the week, okay? Now, I want to kind of come down through this and kind of maybe just kind of point out some of the examples that some investors might be looking for this week, okay? Now, after the close, Waste Management is probably one of the biggest ones, maybe Cadence, NXPI Semiconductors, Nucor, some of the bigger ones that are announcing. If we go down to, for example, click on that 29th date, I want to kind of just show you some that are standing out. Coca-Cola tomorrow morning, okay? If you actually like to look at real estate, American Tower, this is before the open. And you're now going to see that when we look at, let's say, Altria, that is also announcing Sherwin-Williams. Now, this also shows us the after the close. And this is where we get to the bigger horses. Visa, Booking, Starbucks, Mondelez, and many others, okay? Now, the one thing we will say is PayPal is also tomorrow morning, okay? And we're going to look at some of these, don't worry. If we went to Wednesday, for just real quick, some of the ones that are standing out a little bit, Caterpillar's on Wednesday, okay? We also see in the afternoon, you got Microsoft, Meta, QCOM, okay? You also see Aflac, MetLife, Allstate, Public Storage, quite a few. And then Thursday, it's full on bananas, okay? Thursday, we actually get MasterCard, Mickey D, okay? ICE Intercontinental Exchange. You also get CVS, which is going to be interesting because there's been discussion upon, is it going to stay like a public company or are they going to take it private, okay, or try to? And then Thursday afternoon, this is where it hits. Apple, Amazon, MicroStrategy, Airbnb, and so on, CNI. So it's going to be kind of interesting to see kind of how the tariffs have actually affected some of these trucking companies and also the rails. Friday, I won't click on it, but Friday we have ExxonMobil, okay, Chevron, and we also have Cigna, okay? Now, this is all great and good, but we kind of have to have maybe a strategy perhaps to maybe try to play some of these. Now, I want to kind of talk about this for just a second, okay? When you go to, let's say, Learn, and you go to our courses, we have 3 courses on options, different levels of options. And if you click on them, any of the reference to implied volatility is actually in the section of the strategy itself. I think it's worth the time to invest to pull out those 2 words there, implied volatility, and kind of talk about that in terms of an indicator and how to actually use it with technicals, especially as we're in the week of earnings. I think that I want to pull it out, okay? And we're going to kind of shine a light on it here. Now, what I'm going to do is if I were to ask you, when you look at, let's say, implied volatility, what strategy do you like to use with it if it's high implied volatility? So let me kind of pull up something just real quick. I'm going to pull up a chart and I'm just going to start it. Let's pick a stock like Amazon for just a moment. And actually, if you don't mind, let me pick Tesla, okay? Tesla. And what I'm going to do is I'm going to kind of let's start with a chart and I can click on the test tube, okay? Click on the test tube. And what I'm going to do is I'm just going to pull up this implied volatility. Now, the reason I want to kind of start here is if you said, hey, James, if I click on that little question mark, what is it going to be doing? Okay, and it gives a little definition. If you want to learn more about implied volatility, you can actually see more details there. Just always remember the little question mark, okay? Now, what you're now going to see is if I go to add selected, it's going to show that it's going to be on the lower study. Let's click on apply. Now, as I click on this, you're now going to see that every stock has a different range of implied volatility. If I looked at a stock like Walmart, and then I looked at a stock like Tesla, they're different, okay? Now, thank heavens they're different. I mean, it wouldn't be fun if everything was the same. Now, what you're now going to notice is if we said, where's the low of the implied volatility for the last year? Well, the low or the low end of the range, we'd probably say if it was low over the last year, probably say if it got below 55. If we kind of said what's in the middle, just kind of guesstimating, probably say in the middle would be between 55 to 75 in the last year. And if we said what's the high, probably say anything that's above 75. Okay? So what we need to understand is implied volatility is not always going to be in the same levels. Okay? So if someone were to ask you a question like, what is implied volatility? What would you tell them? How would you explain it to them? Okay? So if someone asked me and say, what is implied volatility? I think of it as an expected move for a certain period of time. So what you're now going to notice is implied volatility can be stated in two different ways. It can be stated in terms of a dollar amount, but also an annualized percentage. And we could see that by just going to the trade tab. Now, the reason why we said the implied volatility, it's a forecast, okay, of the expected movement. Now, remember, it's not just looking at the downside, it's looking at the down and the upside. And the higher the volatility is, the greater the expected movement up or down. Think about it as a wider range of potential movement. Now, when we go to the trade tab for just a moment, got the Tesla there, and what you're now going to notice is what causes the implied volatility to be high or low. Well, let's go back to the chart for just a sec. When this implied volatility was at the very peak, is Tesla correlated to anything? Or is it on an island unto itself? Well, no, absolutely not. It's not an island unto itself. What happens in the marketplace, the SPX, the NDX, etc., we could be running correlated to what happens in the marketplace. If you saw when Tesla was at the peak of volatility, that was also probably when the VIX was at the high. Now, let's just make sure, was that true? Is it close? Well, the April 8th was the highest it got. Okay, it was at 118. So let's pull this up for just a sec. VIX. When did it peak out? The date was April 7th. So we were 1 day away from when Tesla hit its implied volatility high. It was 1 day after the VIX hit its high. So the reason why I kind of bring this up, I don't want you to think that every stock is independent upon what the market is. That's not true, okay? The stock is a boat on the ocean of the marketplace, okay? Now, what I'm going to do is I'm going to pull back up Tesla for just a sec, and what you're now going to notice is it's going to show the implied volatility in really two different ways. So first off, we have the 2nd May here, which is this Friday, 4 days remaining. And you're going to see that it expresses the annualized implied volatility at 92%, okay? Now, the higher it is, the more and this is annualized, okay? So I think it's kind of funny you can even say the word annualized, okay? People talk about annualized, people don't like that. But for the implied volatility, we'll take it, okay? Now, if you take a look at this, 92%, okay? Now, the higher the percent, the greater the forecasted movement, okay, up or down. Now, you're also going to see that this plus or minus 21, that is really, it could go up or down 21 points until when? Well, that's the forecast for the next 4 days. That's unbelievable, okay? That's like 21 points on a $276 stock. That's almost 10%, exactly, okay? Now, 11 days out, let's think logically through this. Wonder if we give it more time to move around. Well, if we give it more time to move around, we'd probably think that the movement would be bigger. It is, 32. And if we said, let's give it more time, 18 days, it's 40 points. And notice what you're going to see is as we give it more time, the dollar amount that it could go up or down increases. But if we look at, let's say, the percentage, over time, what you're going to notice is that implied volatility is most likely going down, especially if we've just had earnings. Okay? Any questions? Now, so just real quick, okay? So what causes the volatility to rise? We could be going into the earnings and investors are forecasting a wider range of movement on the stock, and if they're forecasting a wider range of movement on the stock, okay, that could be good or bad, depending upon what strategy you pick and if you picked a direction, okay? Now, the comment from Carol is, why in the heck are we at 27 on the VIX? Easy answer. Well, if the SPX, let's say, is at 4,600, and investors actually are having a harder time, if investors are maybe thinking that, hey, there's a lot of news hitting the marketplace, a lot of news, well, that means the market could go up a lot or it could go down a lot. And if we have a lot of earnings that could cause the market to go up a lot or down a lot, the range in the marketplace is higher. Now, I remember years ago, I think it was 2006, the market didn't have any news to it. There wasn't really any earnings during that month of July, I think it was. And I swear on my life, the market, you kept looking to see if your internet was connected. And the VIX, I think, went below 10. Okay? Now, I said, what causes that fluctuation? It could be news, right? It could be earnings, etc. It could be individual stock movement itself, just maybe the company, which we could tie that into news. So right now, we're kind of in this where the volatility of the market is greater because we have news, we have earnings, and the news has played a big part of it. Can the news play into the movement of the stock? Of course, and that's what we showed with Tesla. Now, Carol, if I were to ask you that question, can news cause it to go up a lot or down a lot? What would you say to that? If Carol says yes, then that's why the VIX is a little more elevated than normal, okay? Yeah. Now, let's kind of go back to this. Now, some investors kind of look at this as, oh, higher volatility is bad. Well, remember, one of the most profitable trades in the margin account is going bearish the VIX, okay? Not the VIX, not VIX, a different ticker, but that's the most successful trade so far for the year that's still on. So some people, they kind of like to look for volatility either to go up or down, okay? Lately, in the paper money account, the margin account, it's been playing really, and it has a trade on the VIX going down, okay? Now, what I want to do is I want to kind of talk about, just real quick, some strategies. And I want to kind of look at, let's start with Tesla first off here, okay? Let's kind of talk about how Tesla really kind of affects premiums for just a second, okay? Now, what I want to do to kind of show you this before we do our trading examples and talk about implied volatility plus technicals, okay? Now, what I'm going to do is I'm going to go, I got Tesla, okay? I'm on the trade tab, Tesla, and I'm going to look at the 16 May. Now, just for an example, okay? I'm going to choose the 270 put, okay? Now, let's say we decided, hey, we're going to sell the put as an example. Okay, let's bring up a little sheet of paper and have a little fun here, okay? Now, a lot of people, they might kind of struggle with this, so that's why I kind of want to make sure we kind of talk about it a little bit, and then if we kind of give some construction around this topic of implied volatility, they might consider saying, hey, I understand it better to practice. So what I got the May 16, okay? The strike we're going to look at is the 270 put, okay? Now, if we sold that 270 put right now and got somewhere in the middle, that put is probably going to be about, if we got in the middle, maybe let's just say 1340, okay? Right there. Is everyone with me, okay? So if we sold the 270 and we got that 1340, that's the option premium, and this is the strike, so we could all follow along. Now, what you're now going to notice is if we said, well, what's the break even? Okay, I'm going to put BE at expiration. Break even at expiration. Not today, at expiration. Well, what you're now going to see is we'll take the 270, that's where we have the obligation to buy the stock from now to expiration, subtract out that option premium, 1340. It gives us a break even of 256.60. That's just the strike less the premium. Are you with me? Okay. So this is at expiration. We would need the stock to be at 256.60 at expiration. Now, what some people kind of like to do is they like to kind of say, well, hey, what's the stock price? When you put this trade on, stock price, and I'm talking about stock price like right now. And so they're just kind of wondering. Now, I still remember back in 2003, someone said, oh yeah, you could do cash secured puts and buy the stock at a discount. And my mind immediately thought, well, how much of a discount? Don't just say discount. Well, if the stock price right now is at 277.06 and the break-even expiration is at 256.60, how much of a discount? Now, we know you can do a discount like a dollar amount or a percent. Let's look at both for just a second, okay? So if we said how much of a discount? Well, how much of a discount? It's going to be about $20 lower than where it is right now. Stock's at 277, break-even expirations at 256.60. If we said how much of a discount in terms of, I'm going to put discount, dollar terms, $20.46. Now, I also like to look at that in terms of a percentage, okay? Don't call me a nerd. The reason why I like to look at percentage is if we looked at a $50 stock, $100 stock, $200 stock, when you put it as a percentage, it might make things more comparable than if you put it in a dollar amount. Now you look at a bigger dollar stock, $20 discount from where it is now, well, and you sold a put on a $40 stock, you don't have a $20 discount. So that's why people like to look at it in terms of a percentage. If you said, okay, $20, divide that back into the 276, it's a percent of 7.3%. Now, I'm just going to say something just real quick, okay? When you look at doing cash secured puts, if someone said, what is the discount on a minimum basis that some investors like to do? Minimum 3 to 5%. Or I should say the low end, I'm just going to put that some like to do 3 to 5%, given 20 to 40 days expiration, okay? Medium, we might say maybe 5 to 7. And if we kind of said high, we might say 7 to 10. Now, if that percentage was higher than 10, you might say, wow, something might be a little wrong here. What? Maybe my math's not right, or maybe there's something pending out there that's causing the implied volatility to be really, really high. Might the investor might be a little careful of that. Because if you go higher than 10, there's probably something built in that we might not know about, okay? Now, let's take a look at this. So what I want to do is I want to kind of show a quick example for just a moment, and then we're going to do our trades. What happens if we pump up the implied volatility? What happens? What happens to the premium? Okay? Now, if I went in here and just changed one of the column headings, went to option theoreticals and Greeks, and went to Theo price, okay? So think like a balloon. If I had a balloon, and I just start pumping air into it, well, all of a sudden the premiums should start to go up. Let's look and see what happens. So what I'm going to do is go to the Theo price. I'm going to click on this Theo price, and what I'm going to do is play a little game called Let's Raise the Implied Volatility. The volume here is not volume, it's volatility. And what I'm going to do is say volatility goes up by 10%. Now, if volatility goes up by 10%, what happens to the option prices? Now, what you're now going to notice is when I do that, the bid and ask are the option prices right now. The Theo price column, if we raise up the implied volatility 10%, pump air into the balloon, the Theo price, theoretically, it would become worth 1626. Let's go back to the little sheet of paper. Well, if we go back to the sheet of paper, well, now I'm going to do the same stock price, same strike. Option premium, not 1340. It's now 1621. And now watch the break even. Watch the break even. The break even goes down to 253. It lowers. The discount from where the stock is now is down 23 bucks. And instead of being at 7%, it's at 8.34, 8.39. If we round it up, it's really 8.4. Now let's look at two last ones, show the example. Let's pump it up even more. Let's say you can really blow into a balloon, okay? Let's say we pumped in 20%. Well, you pumped in 20% on that 270, it's now 1853. Now, what do you think investors are doing with this information or considering and doing? Well, when that balloon is really big, the premiums are really big. The premium is really big, the break-even expiration is lower. It's a bigger discount. And the percentage is even bigger, okay? We started off at 7, we went to 8, and now it's at 9.236 if we want to get real technical. Now, what happens if you completely reverse this? Well, let's say the investor said, I'm going to wait for the implied volatility to drop. Instead of doing plus, we're going to do minus. And let's say we do down 40%. And what you're now going to notice is, geez, this wasn't fun. The implied volatility, where the option price is at 1380, but now the theoretical price drops down to 443. Mama mia. Okay. Option premium, 443. Okay. What's the break even? A heck of a lot higher than it was before. What's the discount in terms of dollar terms? 1349. What's the percentage discount? 4.14. So now it should be glaringly obvious. Some investors are looking for higher implied volatilities. Now, you might be thinking, well, do I have to go down through each one of the stocks in the Dow, the NASDAQ, and the S&P 100, and the S&P 500, and look and see which ones are high and look on the chart? No. I want to give you a little bit of a backdrop, though. Okay, now the nice thing about this chart is it shows you what those ranges have been over time. Now, we know when we go to school, we have kids, okay, or maybe they'll tell you, hey, your kid is in the top 10th percentile. Your kid is in the middle, your kid is at the 50th percentile. That's not the great. Or your kid is in the bottom 20% of their class. You know exactly what that means, okay? Now, what I'm going to do is we can also see this in another way before we do our trade. We can also scroll down here to the bottom, okay, and see what we call today's option statistics. And we can see the current IV percentile. So exactly with what we just said, if we're at the 49th percentile, it means that we're in the middle of the range in the last year, okay? And it will tell you where's the high, where's the low, etc., okay? So a lot of investors like to look at what's the current IV percentile to see where we are in that range over the last year. Now, how are we going to marry the implied volatility to the technicals? Okay, here we come. Now, what I'm going to do is I'm going to go to Market Watch for just a moment. And some of the things we kind of need to understand is when to use different type of indicators for when. Just like when you're going fishing, right? It's kind of funny. My son, we were fishing in Kansas one time. My son, I was sitting in the car. I saw a huge splash like someone threw a huge, massive rock. And my son, he was trying to fish with like a chicken nugget. And I told my son, I said, son, I don't think there's any fish that have lips or a mouth big enough to even bite that chicken nugget. You're probably going to just want to do like a small worm, okay? So you got to have to kind of say, what tool or indicator am I going to use to try to get what I'm trying to find? It's not just about having a bunch of indicators. When to use the indicators. Well, so since we're on the week of earnings, we're going to use the tool of that IV percent plus T, the technicals. Now, I'm going to send this out to you just momentarily. And then what I'm going to do is I'm just going to, now, by the way, when you right click on that column heading, right click on it, you're now going to see, now, when I say right click on the heading, when you put this on, I'm going to edit the formula and let me share this with you. Okay. Now, remember something, that when we talk about scripts, they're not guaranteed for accuracy or timing, okay? And when you right click on that heading, okay, now, by the way, when you take the script that's in the chat, we're going to go to setup, we're going to go to open shared item, okay? And what you're now going to see is we can just copy and paste it in. And this will take us through the progression of how do we could name it. And then once we name it, we right click on the heading and say customize. In other words, we want to add on any of the scripts to actually make the columns, okay? Now, the numbers in the boxes is the IV percentile, okay? Now, you're now going to notice that when we look at the IV percentile, okay? Now, by the way, I want to kind of bring this up because there was a question. Does the IV percentile relate to trend? Most likely, yes, okay? The higher the IV percentile, it most likely suggests we're probably more in the trend one. Else, why would the IV be that high? If we saw that the IV was probably in the 20s, the 30s-ish, it's probably more in a trend 3, okay? So good question there. Now what I'm going to do is I'm going to pull up just real quick, let's say the Dow Jones for example, and I'm going to look at these IV plus technicals, right click on it, edit the formula, and now what we're going to see is kind of examples. So if someone says, I want to use the implied volatility, potentially my favorite, it doesn't mean it's always going to work. But I want to kind of trade it, try to sell something. It could be a cash secure put. It could be a short put vertical, and so on. If the investor would consider using options, okay? Now, if we looked at this and said, okay, what are so we know that the numbers in the boxes represent the IV percentile, but if we're a technician, okay, how does this, what do these dark greens represent? The price is above, okay, the moving average, MA, MACD stochastics for more than 3 days. If we have a light green background, it's within 1 to 3 days of the price above the MA, moving average, MACD stochastics. And if we have a gray background, or a gray color, I should say, like that, it's in the middle. It's the number of days are only 1 or 2 days of price above the MA, moving average, MACD stochastics, and the stochastics they're using is slow. If we said, well, I was looking for kind of more of a bearish example, well, there you go right there. Okay, now, NK asked a question. So I opened it. So let me do this just real quick. Setup, open shared item, okay, copy and paste. Now, when we do that, what do I do next? I'm going to say preview this. And since NK asked the question, I'm going to use NK IV percent plus T. All right, so that's not too bad. Just what do you want to name it? Okay, I'm going to use the NK IV plus technicals. Okay, import. Where'd it go? So remember, when we want to customize any of the headings, what we're going to do is right-click on any of the column headings. Right-click, customize the columns. Okay, and what I'm going to do is I'm going to go back to NK, because that's what I called it, and there it is. Okay, now when I do that and say add that, it's going to put NK there, which means it's going to be one of the columns. That's how you just put it on. Okay, now, if someone said, James, I would like to do a bullish trade, and I would like to look for something that maybe is showing some bullish potential, okay? Now, could we just click on these headings right here and kind of rank them from top to bottom, highest percent to lowest percent? Sure, just click on the column heading, okay? Now, the example what I want to look at just real quick is Amazon. If you look at Amazon, Amazon has a 56% IV percentile, okay? Now, the gray background, what does that gray background mean? Well, the gray background just really means that it's only been up for 1 to 2 days. Now, some technicians would say, I like to see a little bit more confirmation. Understand. But I want to kind of show you examples of different scenarios, okay? So this might be a little fresh. Now, what you're now going to notice is, if I go back to Amazon and we go look at the trade tab. Now, let's say the investor said, James, I want to consider doing a short put vertical over the earnings. Okay? Now, remember, in our examples, we like to put them in a paper money account. We're going to use the IRA. Go ahead and just type in Amazon. We're going to look at trying to go out 30 to 40 days or so. Now, I don't have 30 to 40 days in terms of a monthly option, So in this case, we're going to go a little bit farther, like June. Okay. Now, if we had 30 to 40 days, probably choose there to begin with. This is kind of more like wider, like 20 to 50 days scenario. We're at 53. It's probably not the end of the world, just a little bit farther. It's also important to kind of look at the bid-ask spread and if they're liquid enough. And you're going to see that they have a bid-ask spread, 10 cents, open interest, 12,000. Okay. So the two main themes we're talking about is implied volatility. Why do we care? Well, the implied volatility affects the premiums. Why do we care? Well, it affects the break even. Why do we care? Well, it affects the probability of being right. Okay? And so the lower the break even, the greater the potential chances the investor might be right. Irregardless of what I just said, that doesn't mean it's 100% the investor is going to be right. Right? Okay, good. Now, what I'm going to do is we're going to sell the 175. So if we pick, let's say, a strike with a delta of 32, that's just saying, look, there's a 32% chance as of right now, the stock could be below that strike at expiration. The number is not set. It can change based upon volatility and how much time is left and so on. What I'm going to do is I'm going to right click right on the 175, the bid, sell vertical. Okay. So if I sell the 175, buy the 170, and now what you're going to see is there's the credit. Now, when we do like a spread, you're going to see that investors, they tend to really do what's called, well, what's my maximum gain divided by what's my maximum loss. And so what you're now going to see is with higher implied volatility, that ROR tends to be a little higher. This is really at 41%. Now remember, do not take away from the session that, oh, higher is better. Higher is deemed to be more up, they could go up more or down more. Think of it as higher volatility could mean a wider range of movement. Now, what I'm going to do in this is I'm also going to think, well, how much could we lose? Well, in this account, in the IRA, we could probably do 2 contracts of this and stay below the threshold of the acceptable loss. Okay. Now, what I'm going to do in this case is, Helen, you're saying hard for me to see the black background, can it change to white? Yeah, sure. Let's show how we can do that. So I'm going to go send that order. There it is. Go to setup, application settings, and this is where we're all different. That's fine. Okay. By the way, sometimes our eyes different as well. I'm going to look and feel. Okay. And I'm just going to say, let's go light. Okay. Now, if I go light, this is what it's going to show. Let's kind of use maybe a contrast. You can see what that looks like. If you like that, I'm going to go say apply that. So let's go back to this gray color. Okay. We're all different. Okay. So set up your screen how you best like to see it. Okay. Now, what I'm also going to do is let's go back to just real quick Tesla for just a moment. Okay. Now, when I look at Tesla, and I'll put this also on that background so we can see that as well. Let's go light. Nope. And let's put that there. This one won't change. So let me kind of, I'm going to go Tesla. Now, by the way, when we look at this chart, you might really be thinking, pull that up, had some comments last week. Well, don't we want to see this get above really, let's say the 281.30 threshold? Noted? Some might be thinking, James, this is the big upside candle here. And we've actually just pulled back about half of that. Now, if you said, James, I would just really like my chart to have a different background, not a big deal, okay? Go to the little setting gear right there, click on it, and let's just go to where it says appearance, okay? And now what you're gonna notice is it's gonna show here background. Now I have a black one picked, okay? But let's say we wanted to pick a white color there, and there she goes. Apply that, and there it is. All right. So look, everyone's different. Set up the chart how you like, but that's how you could actually do it. Okay. Now I'm going to go ahead and put that back just so we can kind of see it how we normally see it, but that's how we could change it. And by the way, there's also silver or gray there as well. Okay. Now what I'm going to do in this case is if I go back, let me just kind of put that back to, there it goes, apply, there it goes, there it is. All right, now, let's kind of go back to the Tesla. Now, Tesla is still, the implied volatility is still pretty high. If we actually said, hey, I'm going to bring up a market watch, let's do this just real quick. If I went to, let's say, where Tesla is, which is like in the NASDAQ, and I said, let's bring up a personal list, maybe let's go NASDAQ 1 for just a moment. And I'm just going to look and see, there's Tesla right there. So Tesla's in this list. By the way, can you just put this in A to Z? Sure. There's Tesla right there. Now, what you're now going to notice on Tesla right there, it's at the 49. What does that tell us? Well, it's in the middle of the implied volatility range, okay? What does the light green background tell us? Well, go back, add the formula, and what you're now going to see in this case is the investor might be thinking, well, it's within 1 to 3 days of the price, M8, moving average MACD stochastics, slow. What is the difference between the Amazon trade example that we did and also, let's say, versus the Tesla? Oh, it's a main difference. Tesla has already announced earnings, and on those earnings, the implied volatility fell. Now, a lot of the times, whether the earnings are good or bad, and the stock goes up or down, the implied volatility on a high majority of the time tends to fall. Now, I'm going to show you a really bad example, like UNH. UNH was absolutely horrible. Now, this is very unusual where the company announces earnings and the implied volatility goes up. But when do you normally see that? You probably need to have the stock fall down more than 20% to get that type of reaction. Now, a couple days later, it was lower than it was before. But normally what you're going to see is there it was right before. It was at 37. The volatility went up on the earnings, but the stock fell greater than 20%. So that's when you can see that. So if that stock doesn't fall probably greater than 20%, that's probably not what you're likely going to see. You're going to normally see volatility contract. Okay, now in our last trade example here, bring back up Tesla, but that was a question. I'm going to actually bring back up, let's go to the example of the 20 Junes again, 53 days. Now remember, when we talk about delta, the other way we could kind of look at delta is the change in the option value or price over the change in the stock price. In other words, if the stock goes up $1, how much does the options move by? Approximately, theoretically, it's a model. Now what I'm going to do is I'm going to right click on the 250. I'm going to right click on the 250. Now remember, if you said, James, I want to try to sell something farther out of the money. Now this is the last point on the implied volatility. When the implied volatility is higher, the investor might be able to sell something still and get a decent premium, maybe per their rule set, a certain threshold that they want to see. Well, what I'm going to do is I'm going to right click on the 250 bid, sell, and go right to vertical. Now, what you're now going to see is we're selling the 250, buying the 245, $1.67 credit. So I want to kind of summarize what we talked about here today, okay? Implied volatility, especially on the week of earnings, is huge. Volatility really starts to play a role probably about 2 to 3 weeks prior to earnings. But the volatility tends to peak about 2 to 3 days before the earnings. And then after the earnings, unless that stock probably drops greater than 20% or more, volatility tends to contract. This is why some investors might consider some selling strategies to practice. Your homework assignment with many examples this week is to practice strategies that are potentially credit trades, maybe like a cash secured put, short put vertical, an iron condor, something that's a selling strategy, okay? Someone said, James, could I practice a calendar? You could, okay? So feel free. We didn't talk about that, but we'll kind of mention the 3 strategies that I just mentioned. I want you to practice those. You got this week a number of stocks announcing PayPal, okay, Booking, Caterpillar, Meta, Microsoft, MasterCard, Visa, Amazon, Okay, Apple, Reddit, Airbnb. There's not a short list of examples to practice this on and learn from implied volatility. Okay, so today it was really about implied volatility and then using the technical indicators of moving average stochastics and MACD to try to time an entry setup using implied volatility. Okay, now we will have Michael Fairborn coming up next on covered calls and cash secured puts. I want to also thank Brent Morris for answering those questions in the chat, and thanks to you. This is a good learning lesson on how to actually use implied volatility up to and around earnings. With what we discussed, remember we talked about all investing has risk. When we also talk about options carry a high level risk not suitable for all investors. Stay tuned for our next class coming up next. Thanks so much. Take care. Bye-bye.